I'll be glad to, Mark, and welcome everybody. I think the next slide shows what I was thinking when I challenged Costco, although Mark pretty much covered it well for me as also. You see from the slide that we just switched off, Costco is certainly a quality company with those nice up, straight, and parallel signs, and as Mark also pointed out, has performed well since being picked, being up about 33%. And if you think back to that earlier chart that had the red and the green relative return numbers, Costco has a good relative return as well relative to the market. Because of that price run up, you can see that Manifest is saying that the potential return, or the expected return, projected annual return over the next 5 years is just 3.8%. As of today, that's the lowest in the portfolio. As I believe I've mentioned in previous roundtables, I frequently will at least look at, and sometimes it's literally look, just a glance at any company that falls below my par, which is 7.8 today. I think it was 7.9 when these slides were prepared. Mm-hmm. But Costco being about half of that made me look a little bit longer at it. So okay. That's why I said I'll throw it out as a challenge and see what everybody else thinks.
Okay.
A couple of other things that I will throw out. I'm sorry, Mark.
Go ahead.
Well, I talked over you there for a second. Also, I'll just note, while we don't stress current PEs a whole lot, we do talk about, and I believe Ken may be talking somewhat tonight about a triple play where we're looking for an increase in PE. You can see here Costco's current PE is running about 25, actually on a pure trailing basis. I think it was actually pushing about 30 the other day, which is very close to the top of its historical range. And the projected PE you can see on the Eagle that Mark just put up is 18. So that's going to see some PE compression, and that was another reason that I looked at it. And while I am yet not a strong believer in relative strength, those of you who do look at some technical indicators have at least got me looking at it. And Costco's dropped a little bit in the last couple of days, but about 2 days ago was actually in probably the overbought category of a relative strength greater than 70. It's down about 60 at today's price. I think.
Okay,
so
I didn't catch
there
that.
We go. Yeah.
Well, cool. Mark, I'm gonna make a case for investing really being as simple as it seems. And that's what attracted me to Manifest Investing in the first place. Could you click back one slide, please, just for a moment? And I'm going to draw your attention to the portfolio averages at the bottom of the little box at the top of this slide. And I'm looking at this conglomeration of stocks, this collection of stocks, as a true portfolio. And I'm very satisfied with the quality of the portfolio. I'm very satisfied with the par number that's in the sweet spot right now. I love the financial strength and the earnings stability numbers from the portfolio that we're putting together. And while the growth numbers are a tad low for my tastes, I think it's still within the range that Nicholson indicated we should be able to use to end up with a +5 relative return. I'd prefer to see the growth number up maybe closer to 11 or even 11.5, but I can buy the 10. The point I'm trying to make is that since I regard Costco as a really solid, great, high-quality company, I regard it as a core holding. I'm going to vote to keep it in the portfolio as long as the portfolio's values are in this acceptable range that I just pointed out. The only time that I might consider getting rid of a core holding, as long as the rest of the portfolio were in the acceptable range, is when the Costco returns began to match those coming from money market returns. And you all know money market returns right now are practically nil. So my vote's going to be to keep Costco in the portfolio, because the portfolio itself seems to be in a very good place, and I don't need to deal with this issue right now. Again, I really do believe that investing can be simplified, and that's what attracted me to the Manifest Investing site in the first place.
Okay, and I would basically second that, but I'm gonna vote the other way just to turn it over to Hugh in his absence. He's obviously unable to join us tonight, but what you see here is exactly as Ken described. I mean, the foundation of the return forecast for the company is based on a growth rate of 9%. It'd be easy to make that 8 or 9% in your studies. Net margins that have consistently been somewhere in that 1.6, 1.7, 1.8 range. You could actually ding this down a little bit, but wouldn't make that big of a difference. Shares relatively constant, actually going down a little bit. But even if your PE were in the 16 or 17 range, I mean, you still have a projected return that is probably positive. I would treat it the same way as Ken, looking at the overall portfolio. I'm just going to cast a contrarian vote so we can lay it in Hugh's court and let everybody know what he decides offline. It'll end up being his decision. Our process here for the challenge is the one that throws down the gauntlet, just makes his case, sits back, and then the three of us become just like judges on American Idol. And by the way, there's a few people from North Carolina here tonight. Congratulations on young Scotty being the new American Idol. He hails from North Carolina. But again, it's down to Ken, myself, and Hugh as to whether he goes to Hollywood, so to speak. And we'll lay this one directly in Hugh's camp and see what he has to say. I'm still
fixated on Jennifer Lopez's her dress, so I haven't got to Scotty yet. Okay.
And the girl can dance. There's no doubt about it. But again, I'm kind of ambivalent here because, as you can see, I actually took the snippet from the scorecard, and this pick is performing very well for Hugh, and for all of us. So it's kind of a no-win, no-lose situation, I think, and we'll kind of leave it in this camp. But if he decides that we should be looking for high returns, that's going to be kind of up to him. So we'll leave it as a deadlocked vote to be decided, and we'll have to tune in to find out what is decided. Okay, let's go ahead and transition into just a quick update on a couple of the holdings. The first one here that I wanted to kick around, and this is the one that Ken had originally claimed, Staples, ticker symbol SPLS. But I think he's right. I think this is another Hugh McManus selection from the August timeframe last year. And the reason that I kind of called this one out is just I think this is a practice that would make sense for us to do with a stock or two every month or so. You can see that this one did outperform the total stock market index, the Wilshire 5000 ETF. That's what VTI is. That's a exchange traded fund that is the Wilshire 5000. You can see that it has kind of fallen behind it, and then it took quite a hit a few days ago. And the reason is they came in with a weaker earnings report, and then they trimmed their full year forecast, and then they had the audacity to actually earn the word odious. I don't think I've ever seen odious in a financial headline, at least not lately. And obviously that's what caused that hit back on May 17th, May 18th. So now we basically have to take a look at the company and decide, you know, has there been significant damage? Did we make a mistake? You know, ask some of those kind of questions. And Cy and Ken, feel free to chime in. One of the things I wanted to point out is it's been enough days have passed that the analysts have checked in with their lower estimates based on the words uttered by the company, those odious words. And you can see that, the earnings estimate over the last 30 days have actually gone down a little bit for both year-end 2012 and year-end 2013. And basically what we do at Manifest is we take that information. We take both the revenue that's shown down here at the bottom and the earnings that's shown here, those same numbers we were just talking about that are lower than they were 30 days ago, and we embed them in an analysis, and here's what it looks like. You know, and in this situation, it's been a little bit bumpy, but you know, now with those actually embedded here, 2011 and 2012, we have kind of an interesting look at the company where that's a relatively low forward-looking growth rate. So we have to kind of ask the question, you know, what is changing here? What's going on? Because obviously back in the front half of that last decade, that growth rate was quite a bit higher. If you go through those first points, 2003 through 2009. So again, we kind of have to ask the question, what's changing? What's going on here? Now, as a retailer, the answer is yeah, the profitability, as shown by the net margin. Am I still there? I'm actually getting a warning here, guys.
You're still on, Mark. You're fine.
Still fine. Okay, good. Let's hope it stays that way. The profitability of the company, as measured by the net margin, has actually cycled a little bit, but that's not enough of a change to explain what we're seeing. So basically, you see kind of the impact of the Great Recession here a little bit. I have to switch back and get my pen here. You know, this is definitely Great Recession type impact back in this time frame that drove the margins down, and we're seeing a little bit of recovery back into this, you know, mid-4 to upper, almost approaching 5% range for net margins. So that doesn't explain enough about, you know where the wheels seem to be coming off the company. We have to look one level deeper. First of all, here's just kind of some confirmation that it's not a really high return company. It's you know, somewhere in that low double digits, that 12%. Notice that with the stock price at 16 and change, it's actually back down in these levels that it hasn't seen since the Great Recession back here, and it's taken quite a hit. But I think the part of the answer does lie in what you see down at the bottom, and sometimes you have to kind of go out and look for other stuff. And in this case, if you track the number of stores, the number of actual retail outlets in place by Staples, you can see a real tapering off of that trend. You know, going back to 2001, 2002, those numbers were climbing pretty steadily. And then when you hit 2008, you can see that it really does taper off. And then that's actually what has been graphed. I used the software to actually graph the number of stores. And basically the company going forward has a much lower growth rate when it comes to the opening of new stores. And what that means to us as investors is that well, the growth rate's going to really come down to and approach what S&P, for example, calls a terminal growth rate, and that's basically the sales growth can only come from same stores, so same sales from stores.
Mark, Ann Manning is making the point that the quality rating has also decreased significantly from the 1st of May till today. It went from 71 to 57.7. So there's a couple of other things acting upon Staples as well.
Yeah, it's probably taken a bit of a hit then on the margin side. I don't know if we saw any financial strength impact there or not. But another good point.
And another thing I will mention, Mark, you mentioned the impact or the slowing down, almost flattening of number of stores or the store sales growth. Remember, everyone, that for retailers, growth comes from one of two sources, either increase in retail space, which frequently is number of stores. You can also measure it by square footage, but number of stores is commonly how it's done, and comparable stores, that is growth in sales in stores generally open more than 12 months. A point that Pat Dorsey made in his book for retailing companies, and in my experience since I read it, kind of following it, tends to agree. My anecdotal evidence tends to support what he said, is that when a company starts going so flat with its store growth, like you're seeing with Staples, you actually get a double whammy because the comps also usually go down. Because the reality is, while we conveniently say a store matures over 12 months. That's why you look at stores open more than 12 months. In reality, most companies, their stores don't reach full maturity till 18, 24 months. So you are getting some, when you're in that high growth in the store phase that you see through 2000, from 2006 to 2010, those younger stores, the ones between the 12 and 18 months or 12 and 24 months, are actually kicking up your comps. And when you no longer have those, your comps also fall.
Mark, we have a comment from Chris Hodgkin. Chris, you're unmuted.
And you saw that in the total growth, flattening
out. Am I being heard?
Mark, this is Chris Hodgkin with a comment. Go on, Chris.
Hi, Chris.
I think we need to keep in mind one thing, though, that store openings are no longer perhaps as important as they used to be. Staples is doing a lot of selling online, and I believe they purchased, didn't they purchase Quill about 2 years ago, who was an entirely online retailer? I mean, Amazon has not a single bricks-and-mortar store, but they're not doing too badly without opening a single store. So I think we have to look at not only the number of stores, but also have to look at whether a company is able to grow through online retailing and add that into the mix. I'm not sure that Staples is going to succeed in online retailing, but they can certainly keep growing without opening a single store if they can grow their online presence significantly.
Oh, absolutely. It's a great point, Chris. Thanks for pointing it out. It'd be interesting to see if that is in any way accounted for by the retail analysts. I'm going to look for that. That's a very interesting comment. I mean, Manifest Investing doesn't have a store location, and we're able to grow our sales. So, hey.
Mark, we're getting a comment from Jane Johnson. Jane says that she's in the promotional products business, and when Staples entered that business, she sold her Staples stock. She's seen it happen before, that everybody thinks they can handle promotional products, but very few can do it and get it right, especially a large impersonal store like Staples. So it's another business that they entered, and Jane feels that it was counterproductive to what they were trying to do.
That's another good point. I mean, we've seen that in the past. Peter Lynch called it diversification. People that got into businesses were not directly related to their core competencies. So, again, let's go ahead and move on at this point. We'll reflect these changes in our analysis, and it does make quite a change in the position. So if we do get a bump up in price, Staples could very easily end up on the challenge block in an upcoming month.
Mark, we have one last comment from Bob Shaw. Bob, go ahead.
Hey, Bob.
Well, I got rid of it. Staples is the #2 online retailer next to Amazon, with a significant presence in the Fortune 1000 market in terms of delivering product directly to them. Downside is Walmart, Costco, and Amazon have entered their market. So I've looked at it, and I'm still sitting on the fence.
Okay. Good point. Thanks, Bob. Okay, let's go ahead and take a quick look at one last one before we get into our actual individual picks. And we're not picking on Ken. I think it just makes sense to take a look at the ones that have been weaker performers and see how we feel about them today. And this is one that Ken has picked a couple of times, and I'm certainly not worried about it at all. And I think he can explain why neither of us are losing any sleep over this one.
Yeah, well, I find that small stocks are very volatile. And a lot of times when I enter a small stock, not only do I try to gauge where it's going to go on top, but like a classic better investor, I try to gauge where a low point might be as well. I keep notes on the SSGs on stocks that I own personally, and I've made it clear that I do own this particular stock in my personal portfolio. And one of the notes that I made to my wife when we bought this stock was that I wasn't going to panic about the stock moving up and down unless it broke $10 going down. So I was fully prepared for this stock to go as low as $10 in the next year or so. Mark, I think that graphic is on the next slide, where you show the extreme volatility of the prices in this fairly small stock. You'll see that in 2009, it went all the way from 7 to 17, and in 2010, we're looking at 10 to 25. 2008, 7 to 15 and a half, 16, and so far this year, 14 to 21. Not as volatile as perhaps it was in the previous years, but still pretty volatile. I'm holding to this $10 number, and unless it breaks 10 going down, I'm not going to panic too much about it. I love the 22% low estimate that Value Line is assigning the stock. And I'll tell you, unless the numbers themselves are bogus, and there's always the possibility when you're dealing with a foreign country, especially some of these new small Chinese companies, there's always the possibility that the numbers might have some errors in them. I'm trying to be extremely polite. But if the numbers are to be believed, then I still am going to stick with this stock. And in fact, I've added to my position over the last 7 or 8 months, and some of my lots are actually above water right at the moment. So I'm going to stick with this with Zhongpin, and I don't see it deteriorating. I see it following pretty much what a lot of the other Chinese stocks are doing right now at the moment.
Yeah, in fact, I wonder if it's not kind of caught up in the whirlpool of the Chinese small caps right now, and perhaps not deservedly so.
Mark, we have a question from Dan Hess. Dan says that he notices that the Chinese government is trying to fight inflation by requiring companies like HOGS to hold down prices, and of course that will hurt profits in the long run. Susan Galt wants to know, did I get rid of ABAT? And Susan, I never owned ABAT. I never suggested that ABAT was a great investment. I did do some research on that particular stock, but never owned it, and in fact never suggested it for purchase anywhere as well.
She's sneaking in on some other stuff there. All right, let's go ahead and move on then.
Let me just make one quick comment. Ken mentioned his setting a low price of 10 as his potential worry point or whatever. Those of you who've read some things that I've written or heard me speak at conferences know that I do not use the zones on the stock selection guide any longer, and think that the low price is frequently misused. The one way that I do think the low price in section 4 of the stock selection guide can be properly used is exactly the way Ken just used it. That is, come up with a price that you believe could rationally be the low price that stock falls, that if your expectations are met, in other words, your expectation for market conditions, your expectation for potential low profitability are met, and if the stock falls to that price, you don't worry about it. So anyway, that's a lesson for another day, but I thank you for raising that, Ken. I think that is a good use of the low price.
It's good reinforcement, absolutely. All right, well, I think we are to the point where...
And I love your graphic, by the way, Mark. Ride that pig. I love that graphic. Okay.
You got to use that one. Okay, we'll just throw in a quick commercial break here for our producer, Dan Hornick, in case he wants to put a break in the program. This is just our reminder that we, by the way, we are getting an immense amount of interest in this. If you're in an investment club and you want to make manifest investing available to all of your club partners, you can do it for the prices that you see listed there. We do give a special discount for Bivio-based clubs because we love them. This is a one-time offer. It's a special deal. It'll be around for a couple more months. If you're more interested in doing it, like I said, I spent time with a club last night, and I think we had a heck of a lot of fun looking at the capabilities of the site when it comes to helping with either individual portfolios or clubs. Just send me an email. That is my email address down there at the bottom, markr@manifestinvesting.com. The same holds true if you're new here and you would like copies of the slides and you don't have access to the Manifest Forum. But again, you can get access to the Manifest Forum by even just being a trial subscriber and exploring the site.